any market's a good market to buy in. The sooner you buy, the sooner you get the benefit of that ownership over a period of time, whether it's an investment property or your own primary residence, your first time buyer, that sort of thing. Just think about it, if it is your primary residence, think about it long term. What are the 3 best questions to ask that'll ensure that you're working with the most experienced loan officer?
So an experienced loan officer also has to navigate to not put them in a situation in which they're going to spend extra money that they didn't need to spend to buy down a rate that you're not going to keep for super long.
What would you say the most important step is to take when looking into getting a loan?
In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
All right, guys, we're back to another edition of The Blueprint. And today is kind of an ad hoc edition. I'm in the office here. We didn't have a guest this week. And I thought, you know what? There's a lot happening in real estate right now. People are asking questions about, getting into their first home or different loan products, or how can I buy a home with little or no credit, and things of that nature. I'm seeing a lot of buzz. And so I literally got up out of my chair today, walked into the middle of the office, and pointed at Cesar and said, Cesar, come with me. We're going to go rip something about loans. He's like, no, I'm not even feeling that good today. I said, no, we're doing it. So I'm forcing him to be on camera today. So if you're listening to this on one of your favorite podcasts, audio channels, go to YouTube and watch him on YouTube. All right. Anyhow, so here we are. This actually, Micah, nobody's even said anything. This is my first day I didn't wear my arm brace.
Check that out.
Yeah. So not to go totally off track, but you guys have seen me. I was in my cast, then I was in an arm brace. I am tomorrow will be 5 weeks post-surgery. And, if you follow kind of the doctor's schedule, I still wouldn't be fully extended on my arm. But I don't know. Maybe I'm healing quickly. Maybe it's the concoction of injections I'm doing in my body. I really don't know, but I can fully extend. I can't totally supinate my hand, which is rolling it to the outside. Rolling it to the inside is pronating. No problem with that. It doesn't really hurt me. Can't lift anything. I'm still not lifting. Still hard, kind of around the scar area and that sort of thing. Still a little swollen. But anyway, that's why you're seeing me without a cast or brace on. Definitely lost a lot of volume in the arm, but I'll get it back. So we are putting together a full documentary of the progress of me hurting my arm, getting it fixed, and then the healing process that we'll put out in a few weeks ish. And then we'll have a follow-up in 6 months. Anyway, back on track. So today we're here to talk about real estate, loans, purchasing, first-time buyers, things of that nature. And I thought, you know what, Cesar, you're in the trenches every day, and you're way more familiar with product today than I am. Of course, I know the general process and all that sort of thing, but you're helping our loan officers every day, and you talk about different products, and you're talking to the lenders, and today we had an interesting new product that was brought to market. So I just figured let's talk about this for a little while. There's a lot of interesting activity right now. Mm-hmm. Let's kind of roll the clocks back for a minute. You and I have worked together since, what was it, about 2001, 2002?
Around 2000, yeah.
Yeah. Our history together is you were working at a private school.
Yes.
And my son, who's now 29, started to go to this school when he was, like 6?
Kindergarten.
Yeah.
He was one of my kindergartners.
Yeah. And here you were like super personable, and you were talking to everybody, and I thought you'd be great for the mortgage industry, and I kind of recruited you, and you learned from there. So we've been working together for a long time. But more recently, your role has somewhat changed.
Yeah.
You still originate loans, but you're kind of that glue between the company and our loan officers that are spread across the nation.
Yeah.
And so you're helping them price loans, you're helping them place loans, troubleshoot, figure out the best product for our clients and that sort of thing. And there's just so many choices out there. I wanted to kind of go through for our audience, for people who are listening, what that process actually looks like when you first start with thinking about buying a property or refinancing for that matter, and then what the steps are and like what the opportunities are there. So we're at this period of time where the market's been somewhat depressed for about 3.5 years. We're probably coming on 4 years now soon. We came out of the explosiveness of COVID when interest rates had dropped to the lowest point they'd been in more than 40 years, if not ever. And people could get interest rates in the high 2s and the 3%, maybe some in the 4%, depending on where you landed, but still, the rates were extraordinary.
Right.
And what we found on the heels of that, when that dried up and rates shot up pretty quickly in 2022, is that people thought it would come back down. Right. And so the first thought was, I'm just going to wait, right? And then people kept waiting and waiting, and rates moved into the 8s and even touched almost 9% for a 30-year fixed mortgage. And then they've been hovering there for a long time. Now, recently, they've come back just a little bit.
Correct.
So what would you say today if somebody, and it's not a great question, but and we'll address that. But if somebody said, what's the interest rate today? When you think about that, you're thinking about a 30-year fixed conforming rate mortgage. It's a Fannie Mae or Freddie Mac, good credit. In the purchase range of a qualifying for that, what would you say a 30-year fixed is today?
Right now, 30-year fix is probably in the high 6s to low 7s.
Okay.
Realistically.
And that really is a general kind of statement, because every loan that you quote or you talk about interest rates depends on the qualifications, on the credit score, the down payment, what kind of equity you have, how we document your income. It's your credit risk profile, and rates change based on that. So, we've been trained, or people have been trained through society and listening to the news and so forth, that they think the number one most important question to ask when you're thinking about getting a loan is, what's your interest rate? Why is that a bad idea?
My advice for someone selling their home: number 1, do it yourself and save. Number 2, use HomePie.
HomePie makes it easy to buy or sell without an agent. I can list a home in minutes and start receiving offers right away from buyers.
When we discovered that we didn't have to lose $40,000 in agent commission just to upsize to a larger home, it was an obvious choice.
List your home for free at homepie.com. Keep your piece of the pie.
Well, because it's never one size fits all. This is something so unique to everyone. It's like asking, what's the temperature in California? There is not one solid answer because it varies. Where are you at? What time of the day? So just the same way, if you're talking to someone by the water cooler or talking to a neighbor, everyone's profile is different, and rates are tied to risk. So you never know someone's background, what they're doing, the strength of the borrower as far as employment, or the strength regarding their assets and what they bring to the table. So the lender's going to adjust the rate tied to the risk that the customer.
Yeah, you're spot on. Look, if your neighbor, if your coworker tells you, I got the best interest rate from Cesar at Amerifund, and he may have, shopped it around, and Cesar quoted the best rate possible that given moment that day. But rates change every day.
Right.
And so let's just say that you got a quote today for an interest rate, and it was based on your qualification, so it was done right. They didn't just throw an interest rate out there, but they knew your credit score and down payment and all that sort of thing. And then you go to shop that rate tomorrow with somebody else.
Right.
Even if they were earning the same amount, had the same revenue on that loan, the quote's going to be different if they're being honest, right? And not everybody is honest either, and it's kind of like shopping for a car. Are all the cars the same cost coming off the line from the manufacturer? Yeah. But then who gets incentives, and then what kind of margin do they want for the dealership, and what does a salesperson want to make? And at the end of the day, everybody gets a different quote, and you have to go through that process. So what would you say if somebody is thinking about getting a loan, whether it's for a purchase or a refinance? What would you say let me put it this way. What would you say is the most important first step to take when qualifying, What would you say what would you say the most important step is to take when looking into getting a loan?
The first thing I would say is you got to get pre-qualified. Get pre-qualified, look what's realistic, talk and find out. The first thing I do with my customers, or the first thing I encourage the loan officers to do with their customers, is listen to their goals, what they're looking to do, what their needs are. It all starts there. And then I would say, talk to someone you trust, like your CPA. Find out the importance, the advantages. If you're making an investment, it's not for the faint of heart. Like any investment, you go, you do it, you make sure that you're not overextending yourself. And today's guidelines are really designed to protect the consumer from themselves sometimes. We learned back from everything and how the market imploded back in '06, how people wanted something and then they failed. So right now, the system is really designed to not set you up to fail. And that's why those safeguards are there. And sometimes you have to wait longer. You have to put in more work to truly qualify and to set yourself up to be a homeowner. But at the end of the day, the programs are designed, and we have, even with FHA loans, which have had a huge resurgence, and guidelines that are really tailoring so that the consumer can get a home and they get the advantages that come from being a homeowner.
Yeah, I think you're spot on there, and that is the very first step, is get pre-qualified.
Yeah.
You know, I know that people get excited about looking at properties and, you know, going and looking at open houses and things like that, and that's all great. It can get you kind of in the mood of buying something, but if you really want to be serious, you've got to see what kind of loan you can get and that you can qualify. That's the number one first step.
You're going to be excited. Someone else is excited, but if you're window shopping, you're window shopping. But the biggest heartache comes from shopping with your heart instead of your head. And when you do that and you're not going ready right now to make an offer that is competitive, if you're coming in making an offer that has a lot of baggage tied to it because you need the following things to happen, and someone else has taken the time to get pre-approved, has taken the time to know, to get ready regardless of that up or down that might shift with rates, then you're going to lose out. They're going to take the offer that's more aggressive and more organized.
Yeah, let's drill down into that for a second. So, you know, not all pre-approvals are created equal,
Correct.
we'll say.
Right.
You know, some people will go and apply with a lender, and the lender will, you know, not even necessarily gather all the information.
Correct.
They'll just have a conversation. They'll ask them what their credit score is. They'll ask them what their income is, and then they basically estimate what they'll qualify for, and they'll even push out a pre-approval letter for the benefit of that buyer without even checking anything.
Correct.
And what you're saying is, look, if you do that, not only are you shortchanging yourself because you could wind up having difficulties when you go through the process to formally get approved, but you're also making it so you can't be as aggressive as possible if you have a property that has multiple offers on it. Right. And here's where we're at with this market. So people might be thinking, like, multiple offers, like, is that the market we're in? Well, here's the market we're in. More properties are sitting on the market longer, but the ones that are really good are still having multiple offers.
Correct.
And going for above list price. That's literally happening today, and we're not just talking about Southern California. We're talking about across the nation.
Yep.
When you look at these homes that are really nice, and they're in great areas, and they're desirable, they are getting bid up. And I've got example after example. And I'm talking about this weekend. I'm talking about last week. I can go on and on and on where they get beat out. And I'll give you, just bring it all the way home. My son wrote an offer on a property last week in Nashville, and the property had been sitting for 40 days, but all of a sudden had 3 offers on it as soon as he wanted. So here's why. They lowered the price. They finally got into because they wanted a higher price. They lowered it to a reasonable price, attracted more offers,
Right.
And then now more people saw the property, and now it was desirable.
Correct.
Which is another lesson that we'll touch on in a bit, and that is, if you are strategically listing your home,
Right.
do you really want to overprice it or get lower price and let it bid up? But that being said, so we're in this market where things have been depressed, rates are higher. They've come down some. So like you said, we're looking at high 6s, low 7s in general, depending on what some of these
Right.
qualifications were, coming down from the 8s. That's a big difference. We've probably touched in the mid 6s sometime in the last 2 months-ish, where it dropped down a little bit and it popped up. Where do you think we're going with interest rates based on what you read daily staying in touch with what's happening in the market, the reports that are coming out, the pressure on the Fed to drop interest rates globally for the United States for a variety of reasons, including government debt. Where do you think we're headed into the last part of the year here, given that right now we're sitting at the end of July, and so before we know it, we're going to be in Q4?
I think Q4 is going to see more activity. I really do. I think what we're seeing is our rates that had been a lot more volatile, not as volatile, just probably within the last 3 weeks. And I think it's because just turn on any news and you'll see that it's been a topic of conversation. So investors are seeing that. Like I said, FHA is really jumping in. It's trying to make some programs more attractive. We're seeing an increase in down payment assistance programs, and it's just happening more and more.
Talk about the down payment assistance programs,
Sure.
because they've been around for a long time. Traditionally, it might have been related to county or even state down payment
Correct.
assistance, or even city related. But now we're seeing it more widespread than that. Talk to me about the different types of down payment assistance, how they work, those that are forgivable or grants versus those that you got to pay back maybe when you sell the property. Give us an example, a couple of those.
Well, they've come a long way because it really started with being targeted to specific people, to zip codes, to a demographic that maybe was your community service people and other things that were of that nature, but it was limiting. And then what was the standard? Eventually lenders were like, hold my beer. I'm going to go different. I'm going to try to do something that casts a wider net. And nowadays there are down payment assistance almost for any buyer. Any buyer that wants it can probably get it. And like anything, there's layers. So the more aggressive the down payment assistance program is, then the higher the rate. Something that is forgivable, something that is, we saw a 5% program that it was 3.5% plus a 1.5 towards helping towards closing costs, for example. So these are there. There are all kinds of programs out there, and they're layered, and we got to see. And what started off with just being a handful of lenders, we're seeing this way more mainstream. So they're there for you. It just depends. And they have certain caveats. They want to see you stay in the property for longer. They want to see everything from forgivable to non-forgivable, and it really has to be tailored to your situation and what you can qualify for.
Are these also median income driven as well, or are there some that aren't?
They can be incentivized by that. They do some things to try to do that, but when you're dealing with median income, it can also be an improvement. Both Fannie and Freddie have programs that are better rates or have an incentive that the lender contributes as well for better rates for median income.
So what we mean when we talk about median income is this has been around for a long time, and so it's tied to some DPA or down payment assistance programs, but also, like you're saying, Fannie Mae, Freddie Mac have programs where they're enhanced interest rates. They give you a benefit of the interest rate if your income is below the median income for a particular area, whether that's a zip code or a county. And if you aren't working with an experienced lender who knows and is looking at these things, they could basically not even realize it, give you a quote and a rate that's higher than you could actually get.
Right. Absolutely. So this is something that's big. It's not limited to down payment assistance program. We just helped a borrower, and the borrower was putting 30% down. And when we took the time to put the exact income, it changed, and it gave them a huge contribution. And the lender gave a contribution of $3,400. And that was huge. And the rate difference. So it's important to figure out, and like it goes back to just being thorough. And you touched on earlier, pre-qualified, pre-approval, someone who just issues a piece of paper and is just trying to get a task out of the way versus taking the time to make sure that the customer is really in detail. Because anyone in an application can say, I make $10,000 a month. But do you really make $10,000 a month? Can we prove $10,000 a month? Or are you using rounded up numbers?
Or maybe you're not taking into consideration the write-offs that you take, and
Absolutely.
so your net income is less than that.
Correct. So things like that, things like overtime and other things that factor in. But it really means a strong loan officer, if you're going to compare, takes the time to make sure. Because on the flip side of it, we've done things and where we've been able to say, well, someone else is doing a 30-day escrow. We'll do a 22-day. We can do this. If we're organized, we got a lot of the clerical stuff out of the way, we're ready to go and get this thing done in 15.
Yeah.
Just to go within the minimal time that it takes. And
for disclosure periods.
Right.
Right. So look, it's it's no secret that if you work with a really good loan officer who really knows their stuff, you stand a chance of getting a better loan based on their knowledge. Now, we talk a lot about AI in this podcast and what effect is that going to have on the future of origination. And because if you think about, look, everybody's got different qualifications. But at the end of the day, we're asking the same questions. We're asking what their income is. We're looking at their income statements. We're asking what kind of cash they've got for a down payment. We look at their assets. We're asking for their pay stubs. We pull a credit report. We've got all the variety of documentation that we need to pull in, including a story, story of where they're coming from and what they're looking to do. And if you think about artificial intelligence and how, let's say, it's getting perfected, right? So there's a big difference between a loan officer who really knows their stuff. They're a study of loan programs and down payment assistance, and they can maximize based on your story and your situation your benefits based on their knowledge. Mm-hmm. And now we take artificial intelligence and we go, okay, you've got the infinite amount of intelligence of all the different loan programs that are out there. You take all these ingredients from this particular borrower, you cross-check it in milliseconds, and you put out what their best product is, right? And so I think about that and I think, gosh, that potentially could be the future. We're not there yet.
Right.
So will we be? I think we will be. I think we'll have a situation where buyers can come in and apply for a loan, attach all the variety of connections that they need to so that we can verify with the IRS their income. We can verify with their employer their current pay. We can verify their banks with, that all exists. But a scenario where you do all of that and then the AI analyzes it, cross-checks all the variety of programs that are out there, thousands of different programs, and comes up with the top 3. Or comes up with these offers based on, okay, if you want to do a lower down payment, here's your best choice. If you want to do a higher down payment, here's the best choice. If you want to live in the property for a longer period of time, here's the best. Again, right. These are the things that are intangible that come from learning what their goals are, as you said. I think that ultimately we can get there, and we will get there. I don't know what that is, 3 years from now, 5 years from now. But for now, your best shot at getting the best loan possible is to speak with somebody like you, who's in the trenches, who's talking about product every day, who's interacting with the different lenders because every lender offers something different, who's talking to the loan officers with feet on the ground, boots on the ground in a variety of different states across the nation, and really knows and is kind of that computer in your head. As you hear the story, you're figuring it out, and then you're going, okay, what about this program? Did you think about that? What about this one? And helping to figure that out, maximizing the down payment, maybe minimizing the payback. So again, grants or forgivable. Hey, you can be in there for 5 years. This one is forgiven in 5 years, right? And what that means is you don't have to pay it back. It comes off. It's no longer part of your property. So what would you say then on the heels of that? What would you say? You said that a buyer's best first stop is to get pre-approved.
Yeah.
But then how do they find the right loan officer to know that they've got somebody who's experienced enough?
I'd say if you're considering joining the AmeriFund team, it's a really good idea.
We as processors at AmeriFund Home Loans support the loan officers in every aspect of the loan once it comes into processing because we want them out there marketing themselves and originating more loans and supporting more borrowers.
Competitive commission plans are a given, and powerful technology is expected, but what truly sets us apart is our culture. We've built a solid support system for our loan officers.
If you're interested in joining the AmeriFund team, go to amerifund.com/careers.
Again, you said a lot there with the AI and mentioning everything else. It really comes to experience, because if I just type in some information, just like if I was going to try to find the best flight to New York, I can type in information, it'll give me a whole list, and I can figure out and whatever my criteria might be of price or whatever else it can be. But there's so many factors, even in that analogy, just because what time of the day, which is rush hour, when's not. and who's going to lose my luggage, who's not, who has an example. So same thing for us, the experience from a loan officer who knows their things that can get, a spit out of just the best rates or the rates of the day, but who's the best lender, who's going to do it right, who's going to have a track record of doing things efficiently and going forward. These are all key things too, to understand and to navigate and to be able to give the customer the best that they deserve.
So let me put it this way. What are the 3 best questions to ask that'll ensure that you're working with the most experienced loan officer?
3 best questions to ask.
Does the length of time in the business matter?
Well, yes, for sure. What's your experience? How long have you been doing this? I think that's huge. I mean, that's big. Do your research on that. Look them up. Find out. We look up anyone to see, what shoes to buy or what hotel to stay at. So I would say it's important to find out their experience, their reviews, how they are. Being someone who's a licensed loan officer is so key versus just someone that's at a call center. I mean, that's something that's enormous just right there. Just the reachability. You might get someone in a call center that you talk to the first time. You take all the time to give them your story, your goals, and then who knows, you're going to get them again next time you talk to them. So sometimes you have that factor that's in there.
So what I'm hearing from you, number 1, is the length of time you've been in the business.
I would
that's
say
a key
huge.
factor.
I'd say that's very big.
And with that, looking at their reviews online, making sure that people are saying good things about them.
Yeah, for
and
sure.
then the second thing that I hear you saying is, are you going to be plugged in my transaction from start to finish?
Yeah, that's one of the big things. I encourage our team to make sure that they're clear, that they're going to be available not just to the customer, but to questions that the listing agent, the selling agent might have, and just being plugged in every step of the way. What's their communication like? What are they going to do? And then are they going to do what they said they were going to do? Everyone says the right things up front, but can they deliver?
What about how can you ask a question that speaks to the variety of product they have access to?
Well, that's another one. See, so you have so many products and so many things that might go that way. Just a 30-year loan, there's so many layers of just the 30-year loan. Again, knowing what's there and what might be the most beneficial and what's hot, we just try to keep figuring out through communication, not just with the industry, with our lenders, to finding out who's doing what. Just because someone's putting something on sale doesn't mean that they're the best ones to go to. So we get to know that, whoever has any given day the best rate doesn't mean that. I can have the most garbage airline that puts their plane tickets on sale. Doesn't mean I'm going to go there. I'll end up sitting on the wings. So no.
All right. So I want to summarize this for people so they can really kind of have an idea of the best 3 questions.
I wasn't expecting today's.
So let's do it. And by the way, we can jump around. It's fine.
Okay.
Mike is a master of putting it all together.
All right. Good.
So, but yeah, I just want them succinctly to understand.
Sure.
What the best 3 questions to ask to make sure you're working with the right loan officer. So we talked about the length of time you've been in the business, looking at the reviews, right?
Yeah.
We talked about what was number 2?
The length of time in the business, the reviews and knowledge of the product, finding out what's the best product for them. I mean, it's hard for me because I like to just take my time really getting a feel of their knowledge base of what they do know and what they don't know. You can just feel through communication during those first calls of their length of questions or their knowledge, their lack of knowledge, and whether they understand the product, and just taking that time so they feel super comfortable and confident making a financial decision. And that's the big thing. I say it over and over because ultimately I want to give them, our success comes from doing a great job and getting referrals. We're not looking to make a killing on one loan and then be one and done, and later we want to earn long-term relationship, right?
But again, just to help, all that's very true. And it's super important when you're talking with a loan officer that you feel comfortable that they are educating you, that they know what they're talking about and that sort of thing. So the length of time that you've been in the business is important. Does that mean you have to be in the business 30 years? No. I mean, you can be in the business for 5, 6 years and be a real study and know your stuff. So the way they talk to you and what they explain helps you to understand the depth of their knowledge, the variety of the product that they have access to. What kind of loans do you offer? If they offer just conventional loans, maybe not. You know, if they offer conventional, they offer FHA, VA, reverse loans, non-QM, HELOCs. We learned about a product today which was a lease to own. So all of the variety of product that you have access to is also a benefit to a potential buyer.
And the big picture too. There are people that come to you and they say, I need this, I need that, and you're looking at, they have an existing mortgage that there's no reason to modify or touch it because they were fortunate enough to get an aggressive rate not that long ago. Now you're talking about second mortgages. So equity lines, each of them have their own nuances that you got to figure out. And again, figure out their goals with that. And especially because these loans are harder to qualify for than the first trust deed, an equity line. So that brings its own separate discussion.
Totally agree. So look, I think it really boils down to this. If you're a buyer and you're interviewing loan officers, you want to ask 3 questions. You want to ask how long you've been in the business. You want to ask what's the variety of products that you offer, and you want to ask, will you be with me every step of the way from start to close, or do you pass me off to somebody else? And I think those are the 3 most critical questions that you can ask if you're shopping. And then based on those answers, based on your conversation, how they educate you through that process, and then looking online at their reviews, that'll help you to make a decision. But the question about what's your rate, that's not going to get you there.
That's not.
Again, because like you said, and I love that you said this, that's like asking the question, well, what's the weather like in the United States? Well, it depends. What time of year? What state are we talking about? Is this a wet year or a dry year? Like there's so many varieties there that, if they don't come back and start asking you questions to give you the right answer, then they're the wrong choice.
Absolutely. And then I think the other part of this is what's going to happen after I close, because you're doing a transaction in this market in which rates are elevated. Is someone going to be watching the market? Is someone going to do and help you? Because this might be just a temporary time. So if it's going to be temporary and you ask the customer, if rates were to improve the next 12 months, are you going to want to change this existing loan? And almost always the answer is yes. Then especially you got to make sure. So an experienced loan officer also has to navigate to not put them in a situation in which they're going to spend extra money that they didn't need to spend to buy down a rate that you're not going to keep for super long. So this is something that's just a stepping stone to get into the house, to get what you need to be, but that the first chance you're going to get out of that loan and to truly refinance or renegotiate your rate, then that loan officer also needs to be thinking big picture of what they're going to do. And not set them up to where they overspend and they're still recuperating what they spent.
Oh, I'm so glad you brought that up, because that's something that a lot of loan officers don't talk about. And I don't know if it's because of their lack of knowledge or if they just don't care, because it is so true. If your loan officer is not talking to you about the amount of money they're asking you to spend to buy the interest rate down, to pay for closing costs, to pay for points and all those things, and how long the recuperation period may be for you to qualify and make sense of lowering your interest rate through a refinance, then they're probably the wrong choice. They should be talking about, look, this loan is going to cost you, let's say $10,000. Okay? Actual closing costs, not recurring closing costs like interest and taxes and insurance, but actual one-time closing costs. If you were going to save $300 a month, but it costs you $10,000, do the math, people. That's 9 years to recuperate, a little more than 9 years to recuperate that cost before you break even. So if you go to refinance in the next 9 years, you just threw away that money you paid on closing costs for this particular loan. So those are also questions that you should be asking your loan officer. Are you keeping an eye out for lower interest rates? When would it make sense for me to refinance? How low would the interest rate need to be? And if they give you the right answers to those, then that might be a good choice.
The confidence of the loan officer, you'll see many loan officers just timid and afraid to bring it up. You should give full information to your customer so they can then make the choice and give them. The way that the market's set up, we're making the same amount of money as professionals, regardless if you're choosing a higher rate or a lower rate. What we're wanting to do is give you the best sound advice based on your goals, based on long-term or short-term, you're going to be there and figuring that out. And sometimes because we're so conditioned that $699 sounds a lot sexier than $725, even though the payment difference might be $57. But they're so ready to tell them to push them to this direction versus it totally makes sense to take that higher rate. And again, I've told people left and right, sometimes your tiebreaker's your CPA. Find out, see it, and they'll give you sound to advice.
That's good. That's good. It's very true. Look, that lower rate may not be a better deal, right? Because
Correct.
the cost to get there is too much.
Right.
So this is great. Look, in a period of time where interest rates are elevated, talking about the future refinance possibilities, talking about recuperation time and buying down your rate, that all makes sense, and that's what you should be talking about when you're speaking with your loan officer. If you're a first-time buyer today, and especially in a high-cost area, many parts of California, Florida, Texas, it's just not easy. Right. If you're young and you're looking to get into property, it's like it feels like it's just never going to happen. What are some of the things that people can do to make it easier to get into that first property? What are some of the techniques? What are some of the strategies that they could put to play to get into that very first loan? Are you a tech investor looking to shape the future of real estate? HomePie is the #1 for sale by owner marketplace, and we are revolutionizing the way homes are bought and sold. I'd love to hear from you. Just email invest@homepie.com and let's chat. Now back to the show.
Sometimes, and I encourage people to really see it, again, go with your head versus your heart and see it as an investment. And if you're going to start a business, sometimes you need to bring in more partners into it. So if you are fortunate enough to be able to have a family member or someone else that can be a co-borrower, whether it's an occupying or a non-occupying co-borrower. So that is done a lot, just like in the old days where we had parents and family members that assisted someone to get into that first home.
Yeah.
That's a huge way. If that
so
can work out.
Co-signers.
A co-signer.
Down payment assistance,
can be
which we talked about.
Down payment assistance, but again, they have to qualify for it, but it might help them. There are organizations and grants available as well.
What about this program we learned about today?
The program we learned about today was very unique because it had very liberal guidelines to make it a stepping stone to get into the house. It still required the consumer to bring in a down payment, but for the qualification purposes, it was more liberal to get there. And it basically is like a lease to own. It works the same way that if you were renting a house and your landlord all of a sudden worked out a contract with you that said, hey, you know what? Part of what you're doing is going to go towards buying this house. I'd say it's probably the banking version of that.
Yeah.
It looked very good.
What was the required down payment?
The required down payment was still 3.5%, like a standard FHA loan. But then they want to see you bring in 0.5% towards the fees that are required towards the loan, and then they want to see you come in with your first lease payment. And the first lease payment
worked out to be about 5%.
Came out to 5%, depending on the value of the property. It came out to be about 5%. They wanted to see that payment, the loan plus taxes and insurance.
Right, but the qualifications were a lot easier.
You
could use bank statements that qualify, right?
Right.
So your standard FHA loan, you can't just use bank statements.
Correct.
In this product, you could. You can go up to 60% debt to income ratio, which you can't do on a standard FHA loan. But the biggest difference here, like you said, it's a lease to own. So you're making lease payments. Your name isn't on the property. It goes in the name of this lender. But at any point in time, you could refinance it and pay them off. Actually, it's not a refi. It's an assumption. You can assume the note and make the payments on that loan, pay them off for whatever the balance is at that time. Or let's just say, for example, you never did that, but you kept the property for 40 years and you made the lease payments the entire time and you didn't pay any additional principal. they turn the property over to you.
Yeah, you doing it that way. And I believe there was even a caveat regarding the building of equity in it. So it definitely had it, no prepayment. So if you need to do it, it also was very strategic for people who have had to reorganize through bankruptcy. And
one day out of bankruptcy.
One day out of bankruptcy.
Yeah.
So very interesting. Again, these are tools. These are tools available that are designed to be, if you have a unique scenario, if you can't prove dollar for dollar what you make, or you declare a lot of things, you try to take every write-off possible as a business owner, but using the cash flow analysis that's done through deposits in the bank. So I think it really is more liberal in thinking what is possible to show and multiple ways that you can show what you can do, but not setting up to fail.
Yeah. Look, it's an interesting environment we're in. And I hear all the time from people, prices are too high, I'm going to wait till they come down. Every time I hear that, another year goes by, prices go up. Another year goes by, values go up.
Guess what also is going up? Rent's going up.
And rent's going up too.
So rent's going up, and what are you going to get back from your rent versus having the opportunity to get into a home and then being able to build up equity and have something there? So again, it's an investment. And investing is not for everybody, but it is more and more options are there that you can do. And then, like anything, it's not something that you have to keep long term with that.
Yeah. So look, the old adage of marry the house, date the rate, right?
Right.
So there's just so much truth to that.
Right.
We talk about this all the time on the podcast. If you look at the last 75 years of home values, there are only 7 years in 75 where home values went down. That's it, 7 years. And so even if you were buying, let's say in a year where home values go down, let's just say for the remainder of the year, and it's not happening, and there's a lot of reasons why it isn't, but let's just say that you bought a house today and home values went down the rest of the year and next year, and maybe even a year after that. Let's say we hit a real slump. And by the way, it hasn't happened like that back to back since the meltdown in 2007, 2008. Right. But let's just say that happened. Okay, so you hang on to it longer. Property values come back long term, they're worth more. So the sooner you get in, the sooner you can build that equity, the sooner you can get to a point where it's just not unobtainable. If you keep waiting, it may never happen, right? And so the sooner you can get in, the better. Figure out a way. The only way to really know is you have to talk to a lender.
You got to address it. Find out. See what it takes. Again, find out with every year when you're doing your taxes, I'm sure what you're going to get back from renting versus owning something that you can do. And there's times you got to invest into yourself. And just like our retirement accounts, I mean, they go up, they go down, they go up, they go down with our investments. But it's not, we don't do it because you can lose value. It's for the long term.
It's for the long term.
It's for the long term.
That's where you have to think about it.
Right.
Look, I think that we're going to see lower interest rates in Q4. I think there's a lot of pressure on the Fed right now. For a variety of reasons. It's not all tied to mortgage rates, by the way. We'll just be a benefactor of that. Right. It's tied to government debt and the amount that we're spending on that debt versus what happens when the interest rates go down. And now the debt service isn't as much for the United States. So there's a lot of pressure to lower interest rates. There's a lot of indicating factors that show we should be lowering rates, and we're behind the curve on this. And so I think Q4 is really going to be that pivotal time. Here's what's going to happen. Let's just say the Fed drops a discount rate. And that's going to cause long-term mortgage rates to also drop. They're not directly correlated. But in this case, because we've been elevated for so long, that will happen. Rates will come down. It's going to spawn a new threshold of people interested in getting into property because it's a lower interest rate and more affordable. And that interest and the increased amount of buyers in the market is going to cause property values to go up more than they already are in some areas. And in the areas where it's been stagnant or maybe slightly declining, there's going to be more demand. It'll stabilize those areas, possibly cause an increase there. And so if you were thinking about buying a property, the time to do it is right now. and be the benefactor of the lower interest rates that are coming, not only because you're going to see a boost in your value, but then you can refinance into a lower interest rate. And so I truly believe that now is a great opportunity. And like Warren Buffett says, buy when people are selling and sell when people are buying.
Yeah.
Right?
Absolutely.
And we're
It'll
in
create
one
a
of those
frenzy.
periods of time.
I think we'll see a frenzy of it, and also give a sense of urgency to all the people that were waiters. The waiter, and they're just waiting someday this, someday, and they missed their boat the first time.
Yeah.
And now they'll get a reminder. Do I think it'll get as aggressive as we saw? No, I think those are record lows. Don't think we'll see those again, but we will see something comparable with a savings that's aggressive.
All right. One more thing I want to talk about, and that is there's a lot of talk out there that compares the old subprime type of loan to non-QM.
Yeah.
Tell us what the difference is between what we used to have as subprime versus today's non-QM loan.
I think because of the nature of what subprime was, and because the nature of who was buying the loans ultimately, they were really looking for mass volume of loans, and it wasn't qualifying them. It wasn't qualified. The metrics were really at times almost non-existent. You could have a pulse and a social security number and get a loan. Yeah. I mean, that really what it was. So again, my concept, whether it's working with a child, coaching them, or working with adults and getting them a loan, is not setting someone up to fail. And there's times in which you're looking at situations in which people overextended themselves and the consumer was not protected from themselves and impulse, and they bought a house and they overextended themselves and failed, and then we saw what we saw back in 06.
Yeah, so subprime really, it was
subprime,
like these, what we call NINAs, no income, no asset.
Correct.
You didn't even put income on there. There wasn't checked. They had, you could have had a bankruptcy or foreclosure, a month ago and still qualify for a loan. It was really about, like you said, the investor building the volume to make money.
Correct.
It wasn't about qualifications. Whereas today with non-QM,
non-QM,
give us an idea
definitely.
of the variety of product.
The non-QM product really is designed to reach a demographic that has unique income scenarios. We're still going to want to see what you make. You still have to make the money and qualify, but they're taking a lot more things into consideration with the unique aspect of your business.
Yeah.
They're just seeing it. So if you have an aggressive profit and loss, and that can be demonstrated, if you have an aggressive deposits on a monthly basis on your business accounts, if you have aggressive regarding investments and potentials in a property that bring in aggressive rental income that makes sense as an investment, I would buy that property because the rents that it could bring in would more than offset this mortgage payment. So we're seeing all these different, and we're basically almost even seeing some hybrid business loans, which is what the DSCR program is, like the one I just mentioned, based on the potential of rent and using that as the main factor. Do they want to see experience as a landlord? Yes. Do they want to see? And then there's lenders that say, well, maybe you don't have to be as experienced as a lender. We'll try to capture that market. But like anything, rates are tied to risk.
Yeah, for sure. So, yeah, that's a really good point. So the big difference between subprime is they really didn't care that you qualified for the loan. The non-QM, it's thinking outside the box on how can we qualify you.
Yeah.
Do you have enough cash flow? How do your bank statement deposits look? Are you just being aggressive with your write-offs so your income as self-employed looks low, but the reality is you're making enough money to qualify for the payments? Or can we do what has been... here's what I want to talk about with DSCR. So DSCR stands for Debt Service Coverage Ratio.
Yes.
DSCR loans, or the way that they calculate those, which is based on the rental income that the property will provide to pay the payments on that mortgage, including taxes, insurance, and maybe work that needs to be done to the property, as well as vacancy factor, right?
Yeah.
It takes that all into consideration. Well, guess where that originally derived from? Commercial loans.
Commercial loans.
Because commercial loans, that's how you qualify. If you're buying an apartment building that's 5+ units, if you're buying a strip center, a retail center, an office building, they're not going by your individual income. They go by the income the property produces and can service the debt. And so they basically took that model and applied it to residential, and it's become a real winner.
It is.
Because there's so many people that really don't on paper qualify for a loan, but they do when you take into consideration the money that property will generate, whether it is standard long-term rental or even short-term rental income, right? Which we can now do, which we weren't able to do just a couple of years ago.
Correct.
So wonderful products that do help people to qualify, but they're actually qualifying as opposed to subprime, which you just weren't.
It was way more. It was way more liberal. It was not as intense. And right now, these are loans that you still can do and sleep at night.
Yeah. That's true on our side too.
Right.
Look, I think this all boils down to, I believe wholeheartedly, any market's a good market to buy in. Yeah. The sooner you buy, the sooner you get the benefit of that ownership over a period of time, whether it's an investment property or your own primary residence, your first-time buyer, that sort of thing. Just think about it. If it is your primary residence, think about it long-term. Right. That's all. If it becomes short-term and in 2 years you can roll that over into something that's bigger, great. Right. But if you need to be there 5 years to get there or 7 years, so what? It's better than paying rent. Right. And so I think it all boils down to that. We're in a very interesting period of time because interest rates are still inflated. Yeah. And the volume of business is way down, but the good properties are still being sold quickly. And we still have a little bit of time left in the summer. So if you're a seller and you're thinking about selling your property, now's the time to sell it to get the highest price, because people buy when school's out and they want to get their family settled before school starts again. And so you have a bigger audience of buyers when you do that. And if you're thinking of buying, now's the time to do it. There's less competition. And there's more product available than ever before.
Plus, when you're going to sell, you're going to buy something, so you become the buyer anyway.
That's right.
Right? So do it now, sell, and then be in a prime position to buy yourself as a customer. So the key thing I tell my loan officers to remind their customers, and from my own customers, I tell them the definition of the perfect loan is the one that meets your needs. And for every single person, because my needs as a consumer are not the same as my neighbors or as the guy at the water cooler. So that's where I tell people, that's your peace of mind. If it meets your needs, that's the perfect loan.
I love that. That's perfect. That's perfect. Well, hey, I know I scooped you up out of the office. You got a lot of work you're doing. Cesar, thanks for joining me. You did great. See, it wasn't as bad as you thought. And I think we gave some really valuable information for people too. So once again, thank you for joining us on The Blueprint. If you like what you heard, share it, subscribe, follow us, tell people about it. Those are the things that really help. And jump in and give me a review. Those 5-star reviews on Apple Podcasts and other platforms really do help the show. I appreciate you tuning in again today, and we'll see you next time on The Blueprint.